One candle will change your life. If you're tired of all those complicated IST strategies and you work a 9 to 5, you cannot watch the chart all day, this model is going to be perfect for you. And the model I'm going to teach you today is otherwise known as the candle range theory or the next day model. Like, there's so many different names for the same beast, but I want to teach you the exact concept that laid under all these fancy names. So let's get into it. The first one we'll do on the daily, weekly, monthly, the higher time frame is marking out swing highs and swing lows. If you're not sure what swing highs and lows are, I've dedicated videos on liquidity on this channel. So every time we're going up, we mark out old highs, we mark out old lows, old highs. And our model is going to be based around those old highs and old lows. And we want to see how we close the candle around those highs and lows. And what that means is if you have a daily, weekly, monthly extra range liquidity, so an old high, and we close over it, so you see a body that is closing over the high, then we expect the next candle to be bullish as well. Why? If you zoom in on this single candle on the higher time frame, then the lower time frame, you will see this happening. You will see trending conditions to the upside. So when we have a certain pair you're watching, you see this happening. Then the next candle, so let's say this is a weekly candle, and you see this happening on the week, and the next week you're going to anticipate a bullish candle, so an open, low, high, close. And on the lower time frame, that will look like a open, a low, a high, and a close. So you can catch that move right here to take it to the upside. But what if the body does not close above the old high or low? In this case, an old high. We see a rejection happening. And if you zoom in on a rejection candle like this, on the lower time frame, that looks like this. We trade upward, but then when we hit that high, we reject, breaking structure, and we probably also create a lower time for value gap or breaker. So when you see this happening, then you can anticipate the next candle to be a bearish one. So then you play an open, high, low, close to the downside. Price goes open, high, low, close. So when you have your higher time frame highs and lows marked out, look at how they close around those so you can predict the next candle. And very important here that we're not going to blindly trade when we see this candle, we're not going to blindly short. We want to drop to the lower time frame to see these kind of structures happening for the shorts and these kind of structures happening for the upside. So from this point, when we close above a high, I'm going to frame the next candle as a continuation to the upside. We have a run on liquidity and we continue to the upside. And when we have the rejection candle, then we call it a rejection or reversal pattern because price trades to the high and it's not strong enough to continue higher because it rejects. So that indicates weakness and we want to trade the weakness to the downside. And when you are trading this, you now know how to predict the next candle, but you also need a target. And the best targets are also highs and swing lows. So if you're bullish, just long towards the next swing high. And if you're bearish, just find the next swing low to trade towards to find your low hanging fruit targets. So you look at how candle close above a high. If it closed above, you predict the next candle to be a bullish candle. So you play a bullish open, high, low, close. On the higher time frame, this looks like this. On the lower time frame, it looks like with our value gaps or order blocks or breakers. And if reject from a high, that means we are not strong and we want to go lower. Price gives a clue here that price wants to go lower. On the lower time frame, that same candle looks like this. And we need to have a mark structure. We're not going in blindly. We want to have some form of sell structure on the lower time frame to find our trade. And it's going to be towards a target. It's going to be or extra range liquidity or inter range liquidity. Just find the nearest liquidity pool. And if you're not sure what liquidity is, I'll leave the link to my liquidity video in the description. And I created free training on how to go from emotional trading and blowing accounts to securing over $100,000 in funded accounts and consistent monthly payouts. No fluff, just straight value. So make sure you check out the link in the description to watch the training as soon as possible. Cool. Now let's see this in action. Here we're looking at Euro US dollar on the weekly time frame. And let's look at what we do right here. So we have a high right there. And here in this candle, this doji candle, we trade into the high, but we reject from it. And yes, it's a doji, but because we trade into the high, but we fail to displace higher, we expect the next candle to be bearish. We trade lower, we trade lower, we trade lower. We see how the candles are closing in comparison to the previous candle. And here we have a small upwards candle. We also see an overlapping weekly bearish for value gap. And right here, we see a sweep of a high and then a rejection lower. So when we see this candle happening, the next candle we can predict to be a very bearish one. Trade lower, we trade lower. Then we have this massive up close candle. We have created another weekly bearish for value gap. And we do not displace higher. Also, we reject from the for value gap. So that indicated we probably want to go lower. And then we do that. And now you might wonder, like, okay, this is nice on the higher time frame, but how can I trade around this? Like maybe a swing position from 4 hour, 1 hour, or maybe even lower to the intraday time frames. So for that, we need to zoom in. So we know the framework now on the higher time frame, like we've seen right here. So we traded to a high, but we failed to displace above that high. So we expected rejection. And in this example, we also saw some overlapping fair value gaps that also supports that clue that we might not want to go higher, but we want to go lower. We're rejecting. And now let's drop from the weekly to the 4 hour time frame. Here we're looking at that exact same price action, and let's break it down if we could find an entry. Let's start here at the top. So here we have that weekly high, and we tap this here on the Wednesday at 9 a.m. in a kill zone, so that's nice. And then we displace lower, leaving a fair value gap. What I want to see when rejecting from a high, I want to see a market structure shift. And a market structure shift is when the last swing low that created high is violated. So that would be right here. So this price I won't be engaging. I want to wait until we close lower than here, and we do that right there. So we leave a fair value gap. We cannot get tapped into it. As you can see, we just trade lower and lower and lower. So in this whole move on the 4 hour, I would not be in. So yes, you've seen the reversal. Yes, you've seen it happening, but no entries. But it gives a nice indication to what price might want to do. And you see what we do. We reject from the highs. And what are we targeting? We are targeting all these swing lows. Swing low here, here, and there. You see how clean this goes through. So when you see the rejection from the highs and you see price trading down very aggressively, we can look at premium arrays to find even lower price because we can take out all these lows. Eventually, we want to take out these relative equal lows as a part of a bigger market maker sell model. If you're not sure what a market maker model is, I'll leave the link to that also in the description. So we displace here lower, leaving a massive 4 hour fair value gap. So once price comes into this fair value gap, you can already take an entry with your stop above the recent high. And if you're not a swing trader and you can watch the market, you can even zoom in here on this 4 hour fair value gap to maybe look at the 50-minute sell structure. So here we're looking at that same 4 hour bearish fair value gap, but then on the 50-minute time frame. And we have a aggressive sells, aggressive buys here at 4, so in the London kill zone, which is a nice time to make a high. And then we wait for the last swing low that made the high to be violated. That's right there. So once we trade below here, that is where I want to look for sells. And you see this fair value that created with the structure shift. And this is where I would like to take my entry. So that would be right there, stop above the high. Low-hanging fruit would be a 1 to 2 like this. And it would be a very nice trade. And it's all based on the weekly rejection up there, a 4 hour sell structure. And inside that 4 hour sell structure, we're even going lower to the 15-minute to find an entry. So let's go back to the 4 hour time frame. You knew right here that you want to go lower. Here's where there's not a clear entry. Once we displace here in this piece of price action, you could take a very clean lower time frame entry. And you don't even need the 50-minute time frame. You can just take trades from the 1 and 4 hour and you can make a lot of money. But maybe you're like, but I don't want to wait a few weeks to take a trade because this was in September and this was like over a week after this price action. Do I need to wait a week for a new trade to be taken? I would say no, because we are now doing this on Euro US dollar. But there are a lot of other pairs where you're going to do exactly the same as part of a weekly outlook. So at every start of the week, when you want to start trading, go to the higher time frame, apply this concept, look at what looks nice on the higher time frame, and frame your watches around that. And I share my own outlook exactly like this in both the school and the Discord. So if you're struggling with this, make sure to just join. I'll leave the link in the description. But now you know how to do it too. Cool. So let's go back to the weekly time frame. So looking at the weekly, we just took a trade in this area right there. But let's continue doing this. So when you see the model, so for example, right here, you see a sweep of liquidity and also overlapping with a weekly bearish fair value gap. In this piece of price action again, drop to the lower time frame because this is your rejection candle. So for this candle, you might have a very nice trade idea on the lower time frame. Let's drop again to the 4 hour time frame. So here's that weekly bearish fair value gap where we reject off from. Here on this Tuesday, big rejection. In these kind of moves, 99% of the time you are not in. That is fine. You don't make your money right here because this move will give you the direction, the displacement with fair value gaps and other premium arrays, and you need to trade off of that. So when this happens, big range, what I like to do is draw a premium swing high to swing low and discount and try to look for premium arrays. So there's an order block, a breaker. My eyes immediately go to this fair value gap. We have multiple fair value gaps. We have one here on the 4 hour and also one here. Because I want to short and discount, I'm going to make this fair value gap smaller. I'm only going to leave that in premium of the range. And as you can see right here, we tap into premium of the range and then we start rejecting again. So on the 4 hour, you can just have a sell limit at premium of the range. Your stop is above this high. Why above this high? Because this high created high resistance liquidity. We took liquidity before the massive move down and you can target a simple 1 to 2. It would also give you a nice trade. Let's drop again to the lower time frame to see in this piece of price action if we intraday can also find a nice trade. Here we're looking at the same area, but then on the 50-minute time frame. So we start to trade into premium of the range. We also have an overlapping 50-minute fair value gap right here and an order block right there. And look at the time we trade into it, 10:30. That is the New York kill zone. So wait for aggressive buys, aggressive sells. We see some displacement. Ideally, again, we want to see a structure shift. I see a swing low that made the highs right there. So with this candle already, we have the structure shift. So this is a significant fair value gap. Well, if you mark it out in time, you see how it it's respected. So you can already take a trade from here, and you can even take it later in another fair value gap right here, tapped in 2 times. So let's say you miss this initial move and you get in this fair value gap, your stop is going to be above this high, and it's an intraday trade and 1 to 2, like this, and you had TP as well. So it doesn't matter if you trade from the 4-hour or the 50-minute or from the weekly. Based on the framework you just got, you know now how to trade this. You have a rejection candle on the weekly, then you drop to the lower time frame to find your structure. You can do it on the 4-hour, the 1 hour. If you work a 9 to 5, because you don't have a lot of time to watch the chart, but if you have time to watch the chart, you can go inside those 1 and 4 hour levels. You can drop to the 5 and 15 minute to find a intraday trade idea. So from the weekly fair value gap, we had 2 trade ideas that both followed the exact same buy. And this is for when you cannot watch the chart, when you work a 9 to 5, and if you can trade intraday, you can take this trade. Same trade, 1 to 2, and just find the approach that works best for your own situation. And you thought we were done with this? No, of course not, because this model keeps working. So we trade lower from this place, we expand lower, and maybe you're like, yeah, but why didn't I trade all the way back to down here? Because we're looking for low-hanging fruit targets. We just keep targeting old lows. So here inside this weekly bearish value gap, you see that we take out some highs into a premium level and reject from there. So this candle, I'm not interested in. I'm interested in the next candle, this one. So we're going to do exactly the same, drop to the 4-hour to see if we can find an entry. And here you have that weekly bearish fair value gap. And we see that we trade into it right there, here at Friday at 5 a.m. And then we start to trade lower with a fair value gap right there. I see a fair value gap right here. And also I see a fair value gap right here. So if you have a bearish bias, you can take your entry in one of these fair value gaps. I like to wait a little bit. I think this fair value gap is a little too small. So I want to see, do we respect it and then trade lower? So most likely, most of my trades, I will be in this fair value gap. If we trade on the 4-hour, where do I want to trade towards? Well, I see a swing low right here that I want to target, but we also had a higher time frame swing low that we could target right here, that we marked out on the weekly. Either way, most of the time, I just want a 1 to 2. So stop loss above the high for 1 to 2, and it would be right there. You can even go even lower right here, but you can also do 1 to 2. Whatever your preferred risk management is, I think with a 1 to 2, you can make a lot of money. That's what I do. So you would have to trade right here. This is when you work a job. If you want to trade intraday, let's do exactly the same, but then on the 50-minute. So it was the first trade idea. Let's drop now to the 50-minute. So here we're looking at the same price action on the 50-minute time frame. Here we tap into that weekly bearish value gap, and this looks pretty clean on the 50-minute. Aggressive buys, aggressive sells. So we have a market structure shift right there. We have a similar fair value gap right here on the 50-minute. We see on the 50-minute we don't respect this too much because we see some trading above it here during Monday during New York session. We trade back into that original fair value gap right here. So this is going to be the starting point of our trade. I mentioned on the 4-hour time frame that most of my entries are right here, but let's see where we can find our entries using the 15-minute. So here on this Monday, this is already a separate trade idea. What I see here are failure swings, low resistance liquidity. So this is really what I want to target. When I see this happening, we have Asia low with failure swings. This is going to be a target. Then we have aggressive buys, aggressive sells. I'm going to follow fair value gaps and order blocks. What I see here is a 15-minute fair value gap. Let me zoom in a bit. So here's the 4-hour fair value gap. Here's a 50-minute right here. Overlapping. This is your A+ setup here, guys, because you have up close candles that trend to a high, sweeping liquidity. So there's a high resistance liquidity, leaving a bearish order block. We also have a bearish breaker. So this is already an entry which I would like to take right there. Start fair value gap. Target is the failure swings, the Asia low for a 1 to 2. And that's nice because the 1 to 2 even covers a potential tap into right here for a 1 to 2. This is option 1. All based on the weekly and the 4-hour bias. Cool. We trade lower. Look at the time. It's intraday. We're not trading this. This is the market close. We come back in the London session because we're on Euro US dollar. So here we start here at 2. And this is inside that other 4-hour fair value gap. Let's zoom out to the 4-hour. What we're now discussing on the 50-minute is this fair value gap. Let's give it a little different color. I'm gonna give it a green color so you know which one I'm referring to right here. So we trade into a 4-hour bearish fair value gap during London session. And then on the 15-minute, we look into this fair value gap. We see in London session, we see displacement lower, leaving this fair value gap. It would also give you an entry here on Tuesday, right here. Same target, because we have not reached our target yet for a 1 to 2. It will also be same trade. So if you missed the trade on Monday, you can take a trade on Tuesday. Well, let's continue, shall we? We have another fair value gap sitting right here, and that was the original trade idea from the 4-hour time frame. So let's make this one more yellow so we can recognize it. And let's see what we do when we trade to that 4-hour fair value gap. We traded to that 4-hour fair value gap here during the Asian session. And then we move lower. And during the New York session here at 9, we tap into it again and then sell off. So on a lower time frame, I would not have been inside this trade, which is pretty interesting because on a 4-hour, I would have had my limit right here. I would be in the Asian session, but if I would take this intraday, I would not be in because intraday it did not give a lower time frame structure, which is completely fine. That's the difference between trading intraday or trading more as a swing trader like this. The cool part is both are good, both make you money as long as you use the model on the higher time frame, where you have a rejection candle, you go to the lower time frame and find your sell structure. And I think by now you get from this weekly move down, we took multiple trades, both on the 4-hour if you're working a job, but if you can trade intraday, also multiple trades. And we can keep doing this until we are in a higher time frame drawn liquidity. And from this point, when we start rejecting lower, just focus on the swing lows and see if we reject somewhere. So right here, we were rejecting, but then we continued to the downside. If we now fast forward here, because I'm using the replay button, is from this low, we reject. So this swing low, we see that we create a low, then we go higher. And after this displacement from March 3rd is where you need to pay attention, because now we change structure on the weekly time frame. And then you have, of course, your weekly bullish value gap. And when you are bullish, you want to trade to old highs. So right here. And right here, the original short idea will be what we discussed here. I'm not going to bore you with doing this again, but in this time frame, you look at how the candle closes. So this candle trades to a weekly value gap, rejects. So the next candle, this one is where you go to the lower time frame to find your long ideas. Same here. And you can do exactly the same. Here, we look at the live chart here. You have a weekly bullish value gap. We tap into it, we displace. So when this happens, you know that we want to go to the upside towards the next high. And that's right here. And this all on the weekly. You can then drop to the 4-hour time frame as a swing trader to find your entries. If you want to be an intraday trader, you can use the 4-hour as your levels and then your 5 and 15 minutes for your entries. So this far we mainly discussed the rejection model, but we also have the continuation model. So what if we traded to a high, but we trade over it? So we show willingness to continue with the current trend. So in this case, it's a bullish trend. Let's look at some examples. Here we look at a live NASDAQ chart on the daily time frame, and let's start below here. So here we trade into a volume balance, and then we trade higher. And we're going to mark out the value gaps because they play a big role inside this model. Because if you have this model together with a value gap, that is pretty powerful. So let's see the model in action. Right here, we trade higher, we trade higher. This candle closes over the previous candle, so we see another one higher. This candle right here, we reject. So we take the high, but we fail to displace over it. So in the next candle, we are going to look for a lower time frame sell structure. Well, in hindsight, this doesn't happen. You see, there's another buy structure. So in this day, you would or have no trade or you have taken a loss. That's fine. But that same daily value gap is still on. So when price trades into the value gap here and rejects, from this point, this candle, April 30th, is where you're going to look for longs again the next days. Same here. We sweep a low, we reject, and we go higher. We close over it, close over it, close over it until we don't. So we see some weakness coming in, we trade lower, and then we reject again. And where to reject from? We take some lows, but also an overlapping for value gap, and we go higher. We trade above the high, higher, higher. Then we have a massive rejection candle. So this candle, you're going to look for shorts. Well, big doji, so a tricky day. A rejection candle from the order block. Why is it an order block? It's a down close candle. It trades to a value gap, order block, and higher, higher, higher. So based on the one candle model, you could have your whole buys for this move. And if you go to lower time frame, you could find your 1-hour moves right here. Aggressive sells, aggressive buys. You could take your entry here in this value gap, right here. Or your entry in this value gap, right there. And if we go to the next daily value gap, we tap into it right here. This is a trade that took live with you guys on stream. Aggressive buys, aggressive sells. Very nice value gap sitting right there. If you missed that one, you take the next one. So here you could have taken all trade ideas based on the daily structure, 1-hour level. And inside those 1-hour for value gaps, you could even drop to the 5-minute if you want to go intraday. But this video is getting pretty long, so I won't bore you with another lower time frame examples. I think you get the point right now. So you go for your daily structure. Based on the model, you look at how we close above old highs and lows. When you have a bias, you can drop to the 1-hour, to 4-hour to find your entry in there. And if you are an intraday trader, you can go inside this 1-hour for value gaps right here. You drop to the lower time frame to find your buy models as well, but then on the 5 minutes. And when I say one candle will change your life, I mean it. This simple model will get you the buys, both if you work a 9 to 5 or you can trade intraday. This will give you such a clear buys on all the pairs. So now you know when not to trade a pair and when to trade a pair. And when you have a high probability pair on your hands using this model, you can take your trades and get funded, get payouts, make money. If you want to learn more or want to see me daily, I have a school and a Discord group. I will leave the link to that in the description, and make sure you check out the free training I have to get funded, get payouts within 90 days in the free training below. Thanks for watching. I hope you enjoyed. If you did, consider liking and subscribing. Make sure you check out the other videos on the channel as well about market structure, liquidity, daily bias, all that stuff. It's all there. I'll leave the link to that in the description, and hope you enjoyed. See you later. Bye-bye.